Let's get a little bit more insight here and bring in Kathryn Rooney Vera. She's head of global market macro and chief investment strategist at Baltic Capital Markets. I will get it right. Kathryn, always a treat to have you on, joining us today from Miami. Let's start with, I guess, your general outlook here for the market, because it's easy to look at the gains that we've made here over the past 11 months in defiance of the COVID crisis and all the other issues that went on with the economy. This is going to be a remarkable year for U.S. equities. Are you confident that there's still some more gas left in the tank here?
Well, I think that markets are closing in a phenomenally volatile year in a euphoric manner. So I liked the preface to my interview. I think that markets are in a full bull scenario. I think that the vaccine, which is undoubtedly fantastic news, I think is being inappropriately the equivalent to immediate eradication. I think that there's still numerous risks in the near-term horizon, not least of which comes from the January 5th runoff elections in Georgia, which could tip the scales in the Senate. I think the market is not paying enough attention to that. And I think thirdly is economic deceleration. I think that's something that we should really consider as a risk going into 2021, given that lockdowns are going on right now. And until we do get the production, distribution, and successful acceptance, and we know that the polls show that the majority of Americans would not voluntarily take the vaccine. Until we get there, I think that we run a real risk of economic dampening due to intermittent lockdowns.
Interesting you say that, Kathryn. Powell cautioning that to lawmakers today. We got a little bit of a sign of it from the manufacturing data in the US, which does show strength, but in the labor market part of that index showing some weakness. Where then to hedge? Where then, if we are at these lofty levels in the main benchmarks, should you be putting your money to work?
Well, we are at lofty levels, but we have two dominant factors, Caroline, that are going to continue to be the most important forces going into 2021 and beyond until effectively we get some semblance of inflation. And that, of course, is fiscal stimulus, which is, I think, inevitable, and monetary stimulus, which is the be-all, end-all, right? So I think given those two phenomenal forces, when we do get a market drop, it has to be a time to accumulate. I mean, that's been the story for the past 10 years, but the story has not yet changed. So what I'm recommending to our investors is a barbell strategy. Follow the Fed. Of course, we have to do that because we don't want to be out of this game. We don't want to be out of the market and miss big opportunity costs. So we want to be long risk, overweight equities, undoubtedly. But I think we have to rotate out of the U.S. and look for value in the emerging market space. Flows are starting to pick up tremendously there, Caroline. Highest last week since February of 2019. So investors are realizing that rates are going to stay inordinately low for a sustained period of time in the developed world, and we've already maximized value there. So they're starting to look for that yield in the emerging market space.
Does 93 basis points on the 10-year then start to get your attention?
Taylor, you said something before my segment that I completely agree with. When are we going to start talking about yield curve control? And that, I think, too, is inevitable. So once the 10-year, I think, breaks 1% to the upside, the Fed is going to engage in yield curve manipulation. It already is, but I think it's going to be more pointed because, let's face it, a 10-year Treasury yield that is in an incessantly rising trend goes completely against everything that the Fed's been so arduously working towards in terms of keeping mortgage rates low, consumer lending rates low, and expanding and extending this economic expansion or recovery, rather. So I think that it doesn't scare me. In fact, that's the other end of the barbell. I think at 1% and above, you want to go long treasuries. I think you want to buy tips. I think you want to be long in gold. I think you want to buy puts even, just as some protection. And I don't mind having an elevated cash position going into 2021.
And I mean, some of those trades have already paid off handsomely so far this year, Kathryn. For those folks maybe who want to stay, want to maybe look outside the U.S. a little bit more, how comfortable are you right now with the setup with some of those EM names?
Very comfortable, Romaine, and I'll tell you why. The best scenario for the emerging market space is a scenario of low developed market rates, right? So you have that carry trade, combined with a weak dollar. And we have a phenomenally weak dollar. And my expectation is that that's a structural trend over the years. So combine that with flows and underweight positioning in the emerging market space, that tells me that we are just at the beginning of capital flows and portfolio flows entering the emerging market space. So I think combined with economic growth on a global scale, a weak dollar, low interest rates, I think that's setting a very pretty stage for emerging markets, specifically China, and I'll even add to that Latin America, which is still battling, tragically, COVID very aggressively. But I think there's value there.
Still value there. We keep you all eyes on what Kathryn Rooney Vera has her eyes on, Head of Global Macro and Chief Investment Strategist at Baltic Capital Markets. Thank you for coming on and talking about the euphoria in the markets.